The era of unlimited trust in the paper dollar is officially cracking.
Completely cracking.
And that is the startling reality check conclusion we are starting with right out of the gate today. We are looking at a massive shift happening right now, and the proposed solution, bringing gold back into the system, might actually trigger the biggest transfer of wealth in history.
It really could. And I know that sounds like hyperbole to some people, but when you look at the latest news coming out of high-level economic circles, it's kind of the only logical conclusion.
Right. And for everyone listening, this isn't some fringe theory. The mission of this deep dive today is to decode a very real, very current proposal. We're going to look at why the U.S. government is suddenly desperate enough to consider linking our debt to gold again, and maybe most importantly, look at the terrifying historical precedent from 1933 that suggests this whole safety net might be a giant rug pull waiting to happen.
Yeah, if you don't understand 1933, you are walking into a trap blindfolded.
Exactly. So let's get right into the latest updates. The buzz right now is all about a proposal by economist Judy Shelton. She's pitching something called a Treasury Trust Bond.
Mm.
But before we get into the actual mechanics of this bond, what is the immediate context here? Why are they even talking about this today?
Well, the math is finally catching up to the politics. We are seeing a global shift away from the dollar. Foreign nations are quietly dumping U.S. debt.
Because they see the writing on the wall.
Exactly. And more importantly, central banks around the world are buying physical gold at absolute record rates. We are talking over 1,000 tons annually.
Over 1,000 tons?
Yeah, they're moving away from our paper. So the U.S. needs a new way, really, a desperate way, to get people to actually buy its debt.
Enter the Treasury Trust Bond. So let's unpack this proposal. On the surface, I mean, it sounds kind of responsible, right?
It sounds incredibly responsible. It's pitched as sound money.
Right. So what are the actual terms?
A very clever design. The proposed launch date is July 4th, 2026.
Ah, the 250th anniversary of the United States.
Very symbolic. Wrap it up in patriotism.
Right.
So it's a 50-year bond. You lend the government money today, just like you would with a normal bond. But here is the big twist. At maturity, so 50 years from now, the investor has a choice.
Okay.
You can either get paid back in U.S. dollars, or you can choose to be paid in a fixed amount of physical gold.
Whoa. So it's an option.
It's an embedded option, yes.
So if the dollar is basically worthless in 50 years, you just take the gold instead.
Precisely. It acts as an ultimate insurance policy against inflation. The logic is that it restores confidence, because the U.S. Treasury is saying, hey, we are so confident in the dollar that we are willing to bet our actual gold reserves on it.
But doesn't that also force fiscal discipline? I mean, if the government prints too much money and causes massive inflation, every single investor will just demand the gold at the end of the 50 years.
That's the argument. They call it the golden handcuff. If the U.S. prints too much money, investors will flee the normal paper bonds and flock to these gold-backed ones. That would spike interest rates on regular debt and theoretically force the government to stop reckless spending.
Okay, but, and this is a huge bet, but doesn't proposing this in the first place admit something incredibly scary? I mean, you don't offer up your family's silver as collateral if your credit score is perfect.
You hit the nail right on the head. It is a tacit admission by the establishment that the fiat system, the paper-only system we have run since 1971, is failing to hold the world's confidence.
Wow.
You only put gold on the table when the bank manager stops trusting your signature.
So the U.S. knows the trust is evaporating.
Yes.
Okay, so let's look at the math, because this is the part of the latest news that really made my head spin. There is a massive hidden cost here, a massive discrepancy on the books, right?
A gigantic one. And this is the wealth transfer mechanism that nobody is explaining to the average American on the evening news. Currently, the U.S. Treasury values its gold holdings at a statutory rate. Do you know what that official rate is?
I saw this in the notes, and I honestly thought it was a typo. It's $42.22 per ounce.
$42.22. That is the official price on the government ledgers. You have this massive comical disconnect between reality and the government's accounting. Now, think about the mechanics of this proposed bond. If you're going to issue trillions in debt backed by gold, you cannot use gold valued at $42 as collateral. The math instantly breaks.
Right, because you just don't have enough collateral to cover the massive amount of debt we have.
Exactly. So to make these bonds credible, the U.S. would inevitably have to revalue its gold reserves to market prices, or honestly, probably much higher than market prices to create a safety buffer.
Okay, so what does that actually look like? Do they just literally go into a spreadsheet at the Treasury and change the cell from 42 to, say, 3,000?
Effectively, yes. And instantly, the U.S. reserves on paper would jump from roughly $11 billion to over $1 trillion.
Just out of thin air?
Out of thin air. It creates massive equity by changing a number in a ledger. It makes the government look solvent again.
Okay, great for the government. They balance their books, they keep the lights on, but explain the so what for the listener right now. If the government officially sets a super high price floor for gold to back its debt, what happens to the regular dollars sitting in my checking account?
This is the terrifying part. If they revalue gold that drastically, they are explicitly devaluing the dollar. They are announcing to the world it now takes thousands of more dollars to buy a single ounce of gold.
Meaning the dollar itself is worth substantially less.
Exactly.
So if I happen to be holding physical gold in a safe, I'm the big winner here. My value just went to the moon.
You are the winner. Your purchasing power is preserved, maybe even multiplied. But
If I'm just holding paper dollars.
if you are holding paper dollars, or if your life savings are in a standard savings account, your purchasing power evaporates. The pie stays the same size, but your slice gets dramatically smaller.
It's a stealth tax.
It is the ultimate stealth tax. It is a mechanism where the government wipes out its real debt burden by devaluing the currency that regular people use to save and live.
So they save the system by sacrificing the saver.
Yes, and historically, this is the preferred way out for empires in debt, because defaulting outright causes revolutions. But inflation and currency revaluation, that's clean. Most people just see prices going up at the grocery store and blame corporate greed. They don't realize the government just repriced the currency to save itself.
Man, that is a heavy reality. But it actually gets worse, doesn't it? Because even if I hear this and I think, okay, I'll just buy this new Treasury Trust Bond to protect myself, I am still trusting the government to actually hand over that physical gold in 50 years.
And 50 years is a very, very long time to trust a politician.
Which brings us to the trap.
The chart.
We can't just look at this proposal in a vacuum. We have to look at what the United States government has actually done in the past. Talk to us about the Liberty bonds from World War I.
This is the historical parallel everyone needs to understand. Back in World War I, the U.S. sold these Liberty bonds to fund the war effort. It was a massive patriotic campaign. And the contract on those bonds was incredibly specific. It guaranteed redemption in gold coin.
So it was pitched as the ultimate safe investment. Give us your dollars, we guarantee we will pay you back in gold.
Exactly. And citizens bought billions of dollars worth. They trusted the promise.
Okay.
But then the Great Depression hit. By 1933, the economy was in shambles, and the government was basically broke. So President Franklin D. Roosevelt issued Executive Order 6102.
The infamous gold confiscation.
Right. The government just changed the rules. They ordered all citizens to turn in their gold bullion. You were forced by law to hand your gold over to the government in exchange for paper money.
And what was the exchange rate they forced on people?
Roughly $20.67 an ounce.
Okay, so they force you to sell your gold to them for roughly 20 bucks. You get paper. What did the government do next?
Immediately after the gold was safely locked in government vaults, they revalued gold to $35 an ounce.
That is just unbelievable. So they confiscated it at 20, repriced it to 35, and instantly pocketed a nearly 70% profit.
Overnight, the government made a massive profit, and the citizens who followed the law lost massive purchasing power. But here is the real kicker for the bondholders, the people who held those Liberty bonds with the ironclad gold guarantee.
Right, the ones who were explicitly promised gold redemption.
In 1934, those bondholders came to collect. They said, per the contract, pay me in gold. And the government simply refused.
They just said no.
They defaulted on the gold clause. They said, sorry, we changed the law. We are paying you in paper dollars. And remember, those paper dollars had just been severely devalued.
So the investment got crushed.
They lost roughly 40% of their principal's value in real terms.
But how did they get away with that? Didn't anyone sue? I mean, you can't just change a contract after the fact.
Oh, they sued. It went all the way to the Supreme Court, and the Supreme Court upheld it. It established a terrifying precedent. When the government is the debtor and the government controls the currency laws, it can change the rules to avoid paying what it owes.
So when this new proposal pitches a 50-year bond promising gold, history is screaming that it's a trap.
It should create massive skepticism. And it's not just 1933. Look at 1971, the Nixon shock. President Nixon went on television and told the American people that suspending the dollar's convertibility to gold was a quote-unquote temporary measure.
Temporary.
We are now 55 years into that temporary measure. The definition of words like temporary or promise becomes incredibly fluid when the entity making the promise also controls the dictionary.
It's a completely stacked deck.
Entirely stacked.
So fast forward to today. If this Treasury Trust Bond actually launches in 2026, we have to ask a very basic due diligence question. Is the goal even there to back it up?
That is the very first hurdle. For Shelton's plan to even theoretically work, there must be a transparent, full audit of Fort Knox.
Which we haven't had in what, decades?
Decades.
Yeah.
A meaningful independent audit has not happened. Now, putting aside all the crazy internet conspiracy theories, purely from a strict accounting standpoint, do we have the unencumbered physical gold to back trillions in new bonds? We actually don't know.
Right.
The government claims the tonnage is there, but has it been leased out to other banks? Is it secretly encumbered by massive derivative contracts? Without transparency, we simply do not know.
And even if it is sitting right there in the vault, unencumbered, we run right back into the concept of counterparty risk.
Exactly.
Can you break that term down for the listener? We hear counterparty risk thrown around in financial media all the time, but what does it actually mean for a bond like this?
Counterparty risk is very simple. It's the risk that the other guy in the deal won't do what they promised to do. If you buy a house, the counterparty risk is the seller taking your cash and refusing to hand over the deed.
Right.
In this context, a gold-backed bond is still just a piece of paper. It is a promise to pay gold in the future. It is not gold itself.
If you don't hold it, you don't own it.
That is the golden rule. The risk here is that Uncle Sam, your counterparty, won't pay up, or will just change the laws before the 50 years are up.
Which explains exactly what the smart money is doing right now globally. You mentioned earlier that foreign central banks are buying over 1,000 tons of gold a year.
Yes, and look at exactly what they are doing. Central banks in China, Russia, Turkey, even our closest allies in Europe, they aren't buying paper promises. They aren't asking for gold-backed bonds. They are repatriating physical gold.
They are physically moving it.
They are chartering planes and moving gold bars from vaults in London and New York back to their own sovereign soil. They do not want a receipt. They want the hard asset.
That is a massive distinction, and that shows you what they really think about counterparty risk when dealing with the U.S.
Precisely. This bond proposal is really a desperate attempt by the U.S. to keep the dollar relevant. But the actions of the global elite show that they are actively preparing for a reset. They are securing the physical metal because they know that when the music stops playing, paper promises evaporate. In a crisis, the guy who actually holds the gold makes the rules.
That completely reframes how we look at the economy right now. Because as Americans, we're conditioned to view the U.S. dollar as the ultimate safety net. We call it the cleanest shirt in the dirty laundry basket.
Right.
But this latest news suggests the highest levels of our own government know that the trust is running on fumes.
It is an attempt to borrow credibility from a shiny yellow metal because the paper dollar has zero credibility left to spare.
The national debt is over $34 trillion.
Over $34 trillion. Our annual interest payments on that debt are now higher than our entire national defense budget.
Which is staggering.
It is mathematically unsustainable. So this trust bond is the government scrambling to build an exit ramp that doesn't involve a total collapse. But that exit ramp comes at a terrible price for the citizen.
So bringing this down to the ground level for the person listening right now, we have this high-level economic chess game playing out. The government might revalue gold. They might issue these new bonds. They are essentially admitting the dollar is fundamentally weak. What is the main takeaway for the individual?
The single most important takeaway is understanding the difference between price exposure and actual ownership. This trips up so many retail investors.
Explain that difference.
Price exposure means you are just hoping the number on a screen goes up. You buy a gold ETF, or you buy shares in a mining stock, or maybe you buy one of these proposed gold-backed bonds. You just want the dollar value to increase so you can eventually cash out for more paper dollars.
You're still trapped in the paper system.
Exactly. Ownership is entirely different. Ownership is protection.
Yeah.
It means holding the physical asset completely outside the financial system.
Because if the system breaks,
If the system breaks, if the banks freeze, if the rules change, if the gold clause is canceled again like it was in 1933, the person holding the physical asset is largely unaffected. But the person holding the ETF or the paper bond, They are the victim.
It's the difference between holding a piece of paper that says you have fire insurance and actually living in a fireproof house.
That is a perfect analogy. And right now, what we are seeing in the news is the government trying to sell you a brand new fire insurance policy while the roof of the house is already visibly smoking.
Wow. Okay, so looking ahead, the proposed launch date for this bond is July 2026. We still have some time to watch how this specific proposal develops.
We do, but the broader trend is undeniable. The debt crisis is forcing ideas that haven't been discussed seriously in 50 years right back onto the main stage. The mere fact that they are debating gold-backed bonds proves how fragile everything has become. The status quo is officially over.
And relying on the government to act in your best interest 50 years from now seems, frankly, a bit naive.
History warns us over and over again, when governments are backed into a corner and link money to gold, they almost always end up confiscating the gold or devaluing the currency to save themselves. They will always protect the state before they protect the citizen.
The government survived 1933. The bondholders got wiped out.
Exactly.
It's an incredibly sobering reality check. We started this deep dive looking at a seemingly boring new financial product, and we ended up questioning the very foundation of the money we use every single day.
Which is usually where the truth hides in finance.
So before we wrap this up, I want to leave you, the listener, with a final thought to chew on. We all walk around every day accepting these little green pieces of paper, or let's be real, these digital numbers on our banking apps. As intrinsically valuable, we trade hours of our actual lives for them.
Based purely on trust.
Right. We do it because of a collective hallucination backed by the authority of the state. But if the state, the most powerful economic entity in human history, has to reach back 5,000 years to grab a yellow metal just to prove to the world that it's still trustworthy, is the dollar actually money anymore? Or is it just a fading receipt for something that used to have value?
It's a great question.
And when the rules inevitably change again, just like they did in 1933 and 1971, will you be the one holding the fading receipt, or will you be holding the actual asset? Thanks for taking this deep dive with us today. Keep your eyes wide open, and we'll catch you on the next one.